We're expecting all capital cities to see house and unit prices at fresh records, and we are also forecasting Sydney's median house price to hit just over 1.9 million by the end of next year, so that really does set the pathway for a $2 million median house price in Sydney by 2027.
Pretty bullish forecast Domain is painting for house and unit prices in 2026. What is it based on?
We are expecting prices to continue to rise in 2026, and that's largely due to the expansion of the First Home Guarantee Scheme. We've actually got an increase in real incomes as well, and we've also got consumer sentiment rising, which also plays out quite positively well for our housing market when we have got an increase in consumer sentiment.
Economists are divided about the chance of an interest rate cut in 2026. Have you figured one into your forecast?
So what we have figured into the forecast is obviously the impact of the 3 rate cuts that we've seen so far in 2025. That is still going to be flowing into the housing market, particularly in the first half of next year. I think our expectations are probably for one more rate cut midway through the year, but as we know that outlook can change very rapidly.
Domain's report says there'll be recoveries in the Melbourne and Canberra markets, so much so that you are expecting fresh record highs in all capital cities next year.
Melbourne and Canberra have been those 2 capital cities that really have lagged our other cities. They've just moved into an established recovery, and what our expectations are, they will be fully recovered by the end of 2026. And we're expecting all capital cities to see house and unit prices at fresh records. And we are also forecasting Sydney's median house price to hit just over 1.9 million by the end of next year. So that really does set the pathway for a $2 million median house price in Sydney by 2027.
Which capital cities do you expect will put on the biggest gains?
We are expecting a shift in terms of the cities seeing the largest gains. It is going to move back to our interest rate sensitive capital cities. So that is Sydney and Melbourne. When we see changes in the cash rate, they are amplified through Sydney and Melbourne's housing market quicker than other capital cities. So we're not going to be seeing growth being led by the same cities that we've become used to, which has been Adelaide, Brisbane and Perth. We're still expecting growth in these cities, but much more modest compared to those double-digit surges that we've seen in recent years.
Are affordability pressures going to start to weigh on those gains at some point next year?
We're expecting that to happen midway through the year. We think the first half of next year is really going to be spurred on by the expansion of the Home Guarantee Scheme and those flow-on effects from the lower cash rate this year. I think what we'll start to see by the second half of next year is the pace of price growth is going to start to wane in many of our capital cities, particularly in those cities that have seen double-digit increases in recent years.
So Brisbane?
Brisbane is one of those markets. It's still going to rise, but not rise as fast as it once was. And the interesting dynamic that we're expecting for Brisbane is unit prices will actually outperform house prices. That says a lot about affordability and the changed affordability landscape in Brisbane.
And in terms of the differences between house and unit price forecasts for the other capital cities, what can you tell us?
We're expecting house prices in Sydney and Melbourne to outperform unit prices. We're expecting Brisbane to lead unit price growth and see stronger rates of growth for units rather than houses. And that same dynamic is also expected to happen in Perth and Adelaide as well. I think that's just reflective really of the changed affordability landscape in these 3 cities.
Will affordability pressures start to temper the appetite of investors next year?
Investors have been a very interesting segment. They're reacting to capital growth and the prospects of future capital growth. We've seen a strong lift in investment activity recently. And what's interesting, about 80% of investor loans are actually purchasing established housing, which is really not good news, I think, for first home buyers in the market. I think what we're likely to see in the first half of next year is we're going to see investors really competing against first home buyers with the expansion of the Home Guarantee Scheme. I think probably once we start to see capital growth start to slow, that's when we'll start to see investors pull back.
And Nicola, what does this mean for renters? Do you expect to see rental prices also increase for at least part of next year?
We have forecast rental price growth across all of our capital cities, but I would describe it as really modest rates of growth, pretty much in line with inflation. We're expecting a little bit of an uptick in the rate of rental price growth in Sydney and Melbourne for house rents, but most of our capital cities we're expecting unit rents to grow faster than house rents. And again, that really is this steer towards more affordable rental properties, smaller rental properties, because we know the rental market has been extremely strained over recent years.
Okay, Nicola Powell, thank you.
Thank you.